Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Tuesday. It's February 22nd. We did not have a video yesterday because the markets were closed in observation of President's Day. Although I got to say, it was a really interesting day yesterday because Russia, Ukraine, oh boy, they were at it. Matter of fact, I checked the futures last night. I want you guys to see where we're at right now. We're at 33,961. The low was 33,400. We had a 500-point swing overnight, Now, what was interesting was, and we're actually near the higher end of the range right now. Not 100%, but we are much, much better. The high here is 349. We're at 30. Actually, look at this. Almost 1,000. What am I saying? Almost 1,000-point swing overnight. 34,349, 33,406. Like a 950-point swing in the Dow overnight because of fear of Russia invading Ukraine. But I wanted to show you something interesting. I was looking at the futures last night, and actually I was looking at the QQQ, which was mimicking the futures. And when I saw the breakdown, this bar here, let me just show you. This bar actually broke down yesterday. You know what? I think if I show you the futures, you'll be able to see it better. Let me just take a quick look here. Let me see if I could do this. I think a picture is worth 1,000 words in this case. Yes. So this is what I wanted to show you. So as you can see here, we broke down yesterday, right? We broke down on the lows, right? But look at the divergence between the RSI and price. The RSI is telling us it can't even go down to 30, and we're making new lows. So this divergence, or the divergence that happened last night or overnight, and the fact that it's bouncing up like this is telling us that there's a less chance that there is going to be a war between Ukraine and Russia than there was yesterday. Ukrainian president said that he doesn't believe there's going to be a war, and we're having this divergence. Now, I want to show you something very, very powerful and very, very interesting. One of our clients, Germano, sent this to me last night. Look at what happened during an invasion. We dip down, market goes higher. Dip down, market goes higher. Even here, during the Afghanistan war, the market, after a threat of invasion, this is what happens, threat of invasion. The market rallies, the market rallies, the market rallies. So most of the time, when you hear the threat of war, the worst is already behind us. See, if we were getting a threat of war here, I would be really, really nervous. But right now, we're already well below the 200-day moving average. The Fed's talking about 6 or 7 rate hikes over the next couple of years or over this year. But the divergence tells me a bigger story. The divergence is telling us that this index doesn't want to go lower, at least for the time being. So there's a much, much better chance of us going higher than lower. And also, as I said, when you take into account the fact that the market usually, when there's a threat of war, the market usually already prices in most of the downside, it's telling me that most of this is over. Put the call ratio, we got to look at it when markets are open. It was at 104. Anything above 1 is market getting overstretched out to the downside, which is a confirmation. So I'm expecting the markets actually to go higher. Now, if we do break below this 33,500 level, it's going to be bad, but honestly, I think this market is really, really stretched out right now. Like really, really, like the rubber band is just stretched out. Also, if you look at this, and this is important, this is the 200-day moving average. I was showing this to guys last week. We hardly ever go to below 20th percentile on the 200-day moving average. Let me show you 5-year chart. This is the 20th percentile. We're right now at the 30th percentile. So I think even if we dipped, we would go a little lower, and that would be it. Look at this. This is COVID. This is the 2018 rate hike. COVID is a worse environment than right now. I could assure you, a war between Ukraine and Russia is not going to make or break the world, whereas COVID, we could have broken the world. So there's very little as far as the 200-day moving average. And as far as the 50-day moving average, let me just show you something here. As far as the 50-day moving average, we're already breaking down pretty low, so we're near the nosebleed level. So I find it very, very hard to believe that the market's going to crash or fall much from these levels. I think the worst is behind us. Now, looking at each individual sector, consumer staples looks like it can go a little higher. Utilities looks like it's bottoming out and just kind of looks choppy at this point. Energy, depending on what happens, if this is the end versus the beginning, we're going to go lower. But if there is higher escalation of war, we'll see higher prices with energies today. Financials looks like it's going to go back up. It doesn't look like it wants to go down too much. It looks like it's bottoming out. Let's see here. Healthcare looks like it can go a little bit lower. It doesn't look like there's a lot of support there right now. Technology looks like it's bottoming out. As I mentioned earlier today, we were looking at the Nasdaq 100 right here. Looks like we're bottoming out. It just doesn't look like there's a lot of love there for technology. Industrial stocks looks like they're going to be hitting near the lower levels for a while. Consumer discretionary, the sector we've been watching the most, actually looks pretty good. It looks like there's a good chance it could rally from this point. Real estate looks awful. Communication looks awful. And basic material looks pretty steady. So communication sector looks like it's in the toilet. Real estate looks like it's in the toilet right now. Industrial looks okay. Looks like it's bottoming out. We got to be careful with technology and healthcare. And we got to keep attention or pay close attention to consumer discretionary. Another factor you want to take a look at is the bond market. We're seeing flight to quality. We're seeing the bond market rally as of yesterday. But now, because remember, if there's a war, Fed's not going to do anything. They're not crazy. Well, maybe a little crazy. But also keep an eye out. If the bond market starts moving lower, that means there's less fear of war. And the bond market's looking a little lower right now. It actually went up, broke out the high, and now looks weaker. So if the stock market goes up, that means there's less chance of a war. And if there's less chance of a war, there's a higher probability that the Fed will raise rates. Now, in terms of this week, we've got GDP on Thursday. Everybody's going to be watching out for the GDP. If the number is really, really light, the Fed may say, well, with the war and the fact that economy is kind of weakening, maybe it's best for us to not take any action. If that happens, the market rallies. If the GDP growth is really, really strong, they'll say, we told you so. We've been anticipating this, and we're going to raise rates as anticipated. It is a fragmented week, so don't look for too much volatility, especially till we get into tomorrow's trading action. We've got Redbook, which is a private report of chain store sales. That's coming out tomorrow. That'll give us some indication of how consumer sentiment will do, but consumer sentiment should always be here instead of Friday, but we'll complain to the Fed about that. Again, big report is GDP, consumer confidence, consumer sentiment. This is all retail sales. If consumer confidence is good, and if Redbook is good, and if GDP is a little bit on the weak side, we can have a nice little rally. Keep your eye on consumer confidence today. Keep your eye on Redbook tomorrow. Keep your eye on consumer sentiment on Friday, and obviously the GDP and durable goods. This week is all going to be about inflationary pressure, retail, and how it's impacting the consumer. That's housing numbers. Housing numbers I'm not too focused about, and either is the market. Everybody's worried about consumer discretionary. So keep your eye on the GDP, keep your eye on the consumer confidence, and keep your eye on the consumer sentiment and durable good orders. That's going to be really, really important. Now, as far as price levels, let me just give you those levels right now on the SPY. As I mentioned last week, we need to go higher. We need to break above the 200-day moving average. It's at the 445, 446 level. On the QQQ, we need to definitely break the 200-day line, which is the 367, 368 level. And as I mentioned to you guys last week, the biggest factor will be when we break 190 on consumer discretionary. Till we break 190 on the consumer discretionary, there's not going to be any soup. We are going to have volatility. We are looking slightly better. And again, statistically, the NASDAQ stocks trading above the 200-day moving average, we're at 30. Only 30% of stocks, 30 stocks out of 100. When we get down to 20, that's the low. We're almost there. And we had a good 1,000-point swing overnight in our favor, and Ukrainian president is now saying there's not going to be a war. So I showed you what the chart looks like. Every time there's a threat of war, the market rallies afterwards, doesn't go down. The worst, I think, is behind us. Now, folks, today is Tuesday. What do I always show you Tuesday? I show you Tuesday, my top sector, my bottom sector. Right now, the top sector, nothing changed from last week. The top sector is, if I could ever load this, is energy, and the bottom sector is communication technology. Now, why is this not loading? Let me see if I can get it to load. So here's the S&P 500. Top stocks, Devon Energy. Nothing changed in a month and a half. Bottom stock, it was PayPal, Moderna, and Facebook. For some reason, this does not want to load. That's really weird. So here are the sectors. Energy's number one. Communication services at the bottom. And it doesn't want to load. But I'm going to tell you right now, the top stocks, Devon Energy, the bottom stock, Facebook, Moderna, and Twitter. Yeah, PayPal, Moderna, Facebook, and Twitter. Those are the weakest stocks. I don't know why it's not loading, but at least here it is. There it is. Better late than never, right? So there, Devon Energy, top stock, bottom stock, doesn't want to cooperate with me. Bottom stock, as I mentioned, Facebook, Moderna, Twitter. Those are the bottom stocks. And let's see if we can get it done from the other side. There we go. PayPal, Moderna, Facebook, Moderna, PayPal, right there, and Twitter's right there. All of these stocks, the stocks that were making all-time highs last year, are not good no more. Now, folks, tomorrow I'm going to give you an actionable long setup and an actionable short setup with levels. Now, I've got something really, really big, something that's making me very exciting today. Jeff Zananeri, oh boy, he's been nailing all of his predictions and forecasts so far this year, and he's back again with the biggest prediction of his career. Jeff was able to collect 352% on DGX, 30% on Texas Instrument, 20% on MS, on big moves he predicted the past several weeks. So I can't wait to hear what Jeff says is coming next after all this crazy volatility we've experienced from Russia, China, inflation, interest rate headlines. Folks, he's going live tomorrow, Wednesday, February 23rd at 2 p.m. Eastern Time. So you can't afford to miss his next prediction. 2 p.m. Eastern Time, he's going live. You do not want to miss out. Follow the link below to get his predictions and register for his big reveal. Jeff Zananeri's going live. He's got DGX 352% gain, Texas Instrument 30% gain, Morgan Stanley 20% gain, and this is just the last few weeks. You don't want to miss out. It's happening at 2 p.m. tomorrow. Don't miss out. Follow the link below this YouTube video in our Wealth Press channel. Tomorrow, I'm going to give you my top long, my top short, actionable trade ideas. Follow the link. Don't miss out. And remember, I believe we're close to the bottom. Bye, guys. Take care.